part 2 of my series, Can I Use My Excellent Skills in Problem Solving in Physics and Math to Make a Lot of Money in the Stock Market? Okay, so here's the result of a lot of my work. The price of a stock can be simply computed with this equation right here, where EPS is earnings per share in period I. Let's say I are years. IR is the interest rate in period I. And the interest rate includes the risk-free rate, or the U.S. government treasury rate, plus an appropriate risk premium, which depends on the underlying company, how risky the company is, and is equal to the number of years that the company is in existence. Every professional would agree, if you could look into the future and know the earnings per share of a company, say for the next 20 years of its existence, and you could predict the future interest rates for the next 20 years, everybody would agree on the price. There would be no volatility, there would be no risk. Now you've got thousands of professional investors trying to estimate these values, which is virtually impossible to do. You must read/predict the future of a company, the U.S., and worldwide economy. Why all three? Because the earnings for many companies in the U.S., about 40%, come from outside the U.S., and interest rates in the U.S. depend on almost impossible items to predict, such as inflation, U.S. government deficit, consumer spending, consumer psychology, U.S. and international politics, and countless other variables. On average, only 1 in 10 fund managers can beat an investor who randomly chooses 30 or so stocks from the S&P list of 500 companies or the Dow Jones Industrial list of several companies. I believe it's 30 companies. Yes, you heard me. Randomly choosing 30 stocks from a large list of stocks will outperform 90% of professionals. If you don't believe me, try it. So what does this tell us? It tells us that there are lots of random variables and chance in the financial markets. So for a person like me, who is a teacher and applied math consultant, do I think I can better estimate these values better than large financial companies with enormous resources? Probably not. Here's an example of how the returns on stocks in the S&P 500 are correlated to the gross domestic product growth. As you can see, as gross domestic product growth drops, so too do the returns on companies in the S&P 500 and all other indices. And we know that GDP growth is extremely difficult to measure, extremely difficult to predict, because it relies on so many different variables such as politics, government spending, government deficits, etc., etc. The best strategy to invest in the stock market is to invest in the S&P 500 index or some other index which has a lot of companies. By investing in this index, you are in effect investing in 500 of the largest companies in the U.S. Simple math shows that this is optimal. Returns of individual companies average when computing the index return, and risk drops. For example, if there were 2 companies in an index and each had an expected return of 10%, then the portfolio expected return would be 10%. If the stock risk, modeled using the standard deviation of returns of the stock, for each stock was, say, 5%, then the portfolio risk would be less than 5%. That's beautiful, right? Risk dropped, but the returns just averaged. The 20-year return on the S&P index is 10% per year. This could have been a huge multiple, 40% or better, if you were to, instead of investing in the index, invest in the S&P Mini 500 futures contract. However, had the market been down by 10%, you would have been down by 40%. So there are no free lunches. You can invest in the S&P index via countless mutual funds, Vanguard, for example. Okay, so I did a screen to pick a stock that I want to invest in. And the screen I used, talked about this a little bit in my previous video, look for companies losing money, the current price of the company is $20 or less, very little debt, and a small company, and also a 5% rise in the price of the stock in the past month. So I'm looking for a little bit of upward momentum. Okay, so I went through, I think my screen gave me like 30 or 40 companies. So I looked at all of those, and the one I found most appealing from a price chart standpoint was Guardian Health Sciences. Okay, so they are losing money, and they're also losing cash from operations. but the earnings is becoming less negative. Okay, it's growing, and there is positive revenue growth. They have very little debt, so this is good. So a company's losing money and they're losing cash. They've got to be able to borrow, and with so little debt, they've got a lot of room to grow their debt. This is what their price chart looks like. It looked pretty appealing to me. It looks like they're getting ready to break out on a positive trend. Okay, so the indicators I used to determine that this is a stock I want to buy, I used the momentum indicator. I used the rolling EPS. This is showing me that earnings is getting less negative. Yes, they're losing money, but at a lesser rate. Also, I like the recent 3 days, three really strong up days. I've magnified it here. So these are called candles. This is the opening price and this is the closing price. Opening price, closing price. So three in a row, right? Significant gaps in open price and closing price. Okay, so that could be the sign of a very positive trend, what's called a breakout. I also like this momentum indicator, which is an indication of a trend. Okay, so momentum is the rate of change of the stock. So it's the stock price as of, say, now, minus the stock price as of, I think this is 10 periods ago. Actually, 12 periods ago. Okay, so it's giving me an indication as to the rate of change of the stock. Okay, and again, that's very positive. The rate of change is definitely in the right direction. So I feel the timing is good on this. And again, I like the fact that they have very little debt and the negative earnings are becoming less negative. The last thing I'm going to discuss is day trading. Okay, so two of the more popular quantitative methods for identifying mean reversion trades include RSI and Bollinger Bands, and I'm going to discuss these here briefly. RSI refers to relative strength index. Okay, so this is an example of a mean reversion trade. The idea is a stock price tends to trade within a range, even within a trend, right? It tends to stay within a range as it's moving through this trend. So when the stock is down here, you would like a signal, okay, it's oversold and this would be a good time to buy. So what metrics can I look at to give me an indication that this would be a good time to buy? Because if I did buy here, it was going back to the mean, right? And we can make some money. Again, RSI and Bollinger Bands are two very good indicators. Here, it looks like it's broken above a trading range, right? And mean reversion tells us it would go back to the average as it did. Okay. So Bollinger Bands have three lines. The middle line is the average of the closing stock price for the past 30 days or so. And the upper and lower bands are two standard deviations about this average. So the idea is that when the price breaks above or below the two standard deviations, this is a buy or sell sign. But it is more effective when used with the RSI. RSI is relative strength indicator, as I mentioned before. This measures essentially the momentum of the average of the up day closing prices to the average of the down day closing prices. The RSI is proportional to the 20-day average of the up change in the closing prices to the average of the down change in the closing prices. When the RSI goes above 70, for example, this is a sell sign, and when it drops below 30, this is a buy sign. Now, when the two above metrics are used together, the likelihood of success is better, although not foolproof. I've seen many pricing charts when this method gave a false trade signal. MACD is another popular technical indicator, which is the difference between a shorter day exponential moving average and a longer day EMA. When the MACD line crosses the signal line, which is the EMA of the MACD line, this indicates a buy or sell. This is more complicated and a little less intuitive. Okay, so once again, in conclusion, there are a small handful of day traders with many years of experience who use some of these tools and their experience to beat the indexes and make a decent return on their time and investment. I like to look at some of these metrics prior to purchasing an index or stock or currency to possibly better time to trade. But I want to buy that anyway for fundamental reasons. Okay, I don't trade based on technical analysis alone. Okay, so let's look at those metrics using the Apple price over the last 5 years and see if it could have picked out a good time to buy. Okay, so here the price is pretty close to breaking out of the lower band. Let's say it did, and the RSI is at 30. So this would have been a buy time. Okay, this would have been a buy signal. So you would have bought here And let's see, here it goes above 70 again. So here, but it hasn't really broken out of the upper band. All right, it hasn't really broken out of the upper band at all here, or lower band. Well, it broke out of the lower band there, but the RSI isn't triggered down here. Let's see, what about up here? Really hasn't broken out of the upper band there, so no trade there. No trade there. Here it's broken out. Yeah, so here would be a sell. Okay, the stock price is broken outside of the upper band, and you've triggered this. It's above 70, so you would have owned it here, let's say, and you would have sold here. Another popular measure is called the MACD. Okay, basically the idea is when this line crosses this line, that's a buy or sell signal. Okay, so if it's crossing it on the way up, it's a buy time. Okay, so you would buy here, right? You've got that line crossing the orange line, so you're buying there, and then on the way and then you'll sell here, right? It's coming back, it's crossing on the way down, so you would have bought here and sold there, so that would have been a nice profit. You would have bought here, right? MACD lines on its way up above the signal line, and you would have sold here. Okay, so no profit in that trade.